Hey guys, I got three stocks I'm excited to show you that I'm eyeing up to buy this October. Let's hop right into it. The first stock on the list is ticker JD. Among Chinese companies, JD remains one of the few major stocks that is yet to fully recover, and that could change very soon. JD operates as China's largest self-owned logistics network. So, in addition to logistics, JD Food offers other services, with one of them being food delivery, and it has proved to be quite the powerful growth engine, boosting both user acquisition and cross platform selling. Daily orders peaked at 25 million, supported by more than 1.5 million merchants and 150,000 full time riders. It's been their most successive initiative since JD Health. JD Logistics specifically was able to grow revenue by 17% year over year, fueled by expanding their global footprint to over 130 warehouses in 23 countries. Their new facilities are in the US, UK, France, and Saudi Arabia, and they're still pressing forward into more countries. And JD Health, another one of their arms, they continue to scale rapidly. They've been expanding into telemedicine, AI-driven prescription management, rare disease treatment. They're really diversifying the company's healthcare footprint beyond just e-pharmacy of what they've traditionally been. The company's demonstrated their ability to grow. The company's and not only that, but now they are exceeding their historical compounded annual growth rates. And let me show you what I mean by that. If you take a look at net revenues from 19 to 24, they've been growing their revenues at 15% approximately, smoothed out average a year. From 2024 Q2 to 2025, they grew their revenue 22%, and this is total. So now let's start breaking it down. What about, net product revenues and net service revenues? Well, they've been growing at 13% and 28%. Now they're growing at 21 and 29%. Here we go, net product revenues for electronic and home appliance versus general merchandising growing at 11 and 15, now 23 and 16. Marketplace and marketing versus logistics and other service revenues 16 and 43, while 21 and 34. So I mean, out of all of in totality in revenue, they are almost 50% up projected, 22 from 15. And the only service platform that seems to be struggling is the logistics and other service revenue, which, just going down from 43 to 34 isn't terrible. You can't keep growing at 43% all the time. So, I mean, they've continued to strengthen revenue, strengthen the sources where they get their revenue from, and each sector of revenue is outperforming their historical growth, which is very interesting considering the stock price is flat. I mean, this is honestly funny. I mean, look at some of these valuations. I mean, of everything, and I know China will never have value. People have been saying that again. With the recent uptick in BABA, you can see the 13F filings. China's definitely starting to get some momentum here and starting to get priced more like US tech. And I mean, for a company able to grow their revenues and outperform where they've grown their historical revenues at such a size they are now, this isn't a small company by any means. They're trading at 0.2 times revenue. They're trading at 13 and a half times earnings. I mean, this should easily be 30 plus multiple on their earnings, 30x. This is so cheap right now. Then let me show you. Take a look at their price to book value. I mean, if you were to just liquidate the company right now, sell everything, I mean, you're not that far off from what you'd get. I mean, a one times price to book would mean you're paying for the actual assets of the company. You're paying 1.6 times for JD. The quarterly active customers surged 40% year over year at JD. Shopping frequencies climbing at a similar pace, exceeding 50% among JD Plus members. They have extremely high engagement and retention in their customers. This is a screaming, resounding buy for me. So the second stock on mine up here is New Bank. They're a digital bank and a fintech company out of Brazil, and they've been making some big waves recently in the industry, as we'll see. New Bank is absolutely endeared by every person who uses it, and it's pretty clear to see. You'll see in this slide and the next slide. Mexico's not, Brazil's their primary target, but you can see that Mexico, the number of customers quarterly that they've been able to gather, is astronomical. I mean, they're growing at 190% a year. And the big boys are pissed about it. I mean, take a look at this graph here. Mexico's old banking system empires are crumbling. Traditional players under siege from digital banks here. There we are, boy new right here. And you think they're stopping internationally? No, no, no. They're coming to the US, baby. They just applied for a US bank charter to expand out of Latin America. I just want to show you two quick metrics here for new. One, their monthly average revenue per active customer quarterly. They've been increasing at a compound annual growth rate of 33% a year. Then from a cost side, that we have the monthly average cost to serve an active customer has been decreasing at 7% a year. So news on its way here, right? They're going to be in the US here with their charter for their bank out. So let's take a look at some of their competitors. How do they stack up against some of the US big boy banks? Well, they stack up. New Holdings here, a 29.3% return on equity, more than 3 times higher than most US listed banks. I mean, look at them, 10%, 8%, 7%, 5%. The best of them's at 16. News giving you 29%. All right, the third and final stock I'm eyeing up is ticker IOT, Simsera. They're a clear category leader in digitizing physical operations. I mean, they're very much like Palantir. Uh, they maximize safety, efficiency, predictive insights across industries. As of today, they focus on industries like transportation, logistics, construction, which are traditionally largely under digitized, right? What Samsara here is doing is that they've built an integrated hardware and software ecosystem. The hardware, that like asset tags, telematics devices, AI dash cam, etc. It's important, but the real value is in the connected operations cloud, and that platform takes in Samsara's data and turns it into actionable insights across fleet management, worker safety, equipment monitoring. It combines AI, video analytics, and telematics to power things like route planning, predictive maintenance, driver coaching, weather intelligence, and real time communication between dispatchers, drivers, and customers. So, I mean, the tech sounds good, or are the clients happy with it? And it looks like yes, by taking a look at the overall satisfaction across providers, Samsara here got an 84% leading the pack. And just to highlight some things here, they've been growing revenue at an incredible clip. In 2021 here, they're at 250 million, and now they're at 1.25 billion. But the more impressive thing that you got to keep out for, companies profitable, net income, forget that garbage. EBITDA, forget that garbage. Let's look at free cash flow. That's what I care about. So you look at the free cash flow, negative, 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 and less negative, less negative, less negative, less negative, positive. This is what we like to see. The revenue's accelerating, the free cash flow coming in. They're going to need less reliance on debt because they actually have cash coming in their door. So, I mean, they're scaling revenue incredibly and their free cash flow is turning positive. So, not cheap. And, I've said this before, and I'm sure you've heard it. You want something good, you pay a good price for it. And I think you're still in the ground level here. I mean, pretty close to it. And what I mean by that is that they were trading at 220 times, okay, price to earnings ratio. Now they're at 79 times, and you look at these prices, look at EV to revenue, 18 times down to 12 times. Especially if you're just looking at 2025, you're going to think, man, the stock's expensive. There's no juice left in the squeeze here. But on the contrary, companies that are priced, I'm not going to call this price for perfection, but they're damn close. Their price to it at 79 times earning is by no metric cheap. What about when they were priced at 220 times? Think about to the last graph where we see their revenue shooting through the roof. Think about the free cash flow margin turning positive. this is compressed the multiples. And as they keep achieving and hitting their deadlines, this multiple is going to compress further. So, I mean, regardless of the valuation being high, they're executing on revenues, they're becoming profitable, and they're at the forefront of, digesting the AI information to give actionable insight to companies. All right, that's it. That's all I have for you guys. Hopefully, you enjoyed the three stocks I named today. See you next time.